There's a financial strategy so ancient that it predates modern capitalism by thousands of years, yet it remains more relevant today than most investment advice you'll find on Wall Street. This isn't some newly discovered secret or cryptocurrency scheme. It's a principle embedded in Jewish wisdom that has quietly preserved wealth through Roman conquests, medieval expulsions, global economic depressions, and every financial crisis in between. While the world debates the latest investment trends, a small percentage of families continue following a framework that's weathered 3 millennia of chaos. They don't chase returns. They don't panic during crashes. They follow what the Talmud called the rule of allocation, and what we now recognize as one of history's most elegant financial frameworks. The numbers themselves are deceptively simple. Divide your resources into 3 equal parts: 1/3 in land or tangible assets, 1/3 in active business ventures, 1/3 held in liquid reserves. But simplicity shouldn't be mistaken for weakness. This 3-part division represents something far more sophisticated than basic diversification. It's a structural response to the fundamental uncertainties of economic life, designed not just to grow wealth but to protect it across generations, geographies, and unforeseen catastrophes. The brilliance lies not in the individual allocations but in how they work together, creating a financial ecosystem that's simultaneously aggressive and defensive, growth-oriented and security-focused, opportunistic yet prudent. The origin of this framework appears in Bava Metzia, a section of the Talmud compiled between the 3rd and 5th centuries. Rabbi Isaac taught, one should always divide his wealth into 3 parts, investing 1/3 in land, 1/3 in merchandise, and keeping 1/3 in reserve. This wasn't presented as optional advice for the wealthy. It was framed as essential wisdom for anyone seeking to build lasting security. The rabbinical scholars who preserved this teaching understood something that modern portfolio theory would later validate. Different asset classes perform differently under various economic conditions, and maintaining balance across these categories creates resilience that no single investment can provide. Consider what each third represents in practical terms. The land portion isn't just about owning property. It represents investments that are tangible, difficult to destroy, and tend to appreciate with population growth and economic development. Real estate survives currency collapses. Physical assets retain value when paper instruments fail. Throughout Jewish history, when communities faced sudden expulsion or confiscation, those with diversified holdings in physical assets often had something to rebuild with, even if they lost access to their business interests or liquid capital. Today, this category extends beyond literal farmland to include real estate investment trusts, commercial property, infrastructure investments, and other hard assets that provide stability and inflation protection. The business or merchandise portion represents active engagement with economic growth. This is where entrepreneurial energy meets market opportunity. In ancient times, this meant trading goods, running workshops, or investing in merchant voyages. Today it translates to equity ownership, whether through public stock markets or private business ventures. This is the growth engine of the portfolio, the section designed to compound over time by participating directly in productive economic activity. Unlike passive land ownership, business investment requires active judgment, market awareness, and the willingness to accept volatility in exchange for higher potential returns. It's the aggressive component of the allocation, deliberately balanced by the other 2 categories. The liquid reserve is perhaps the most misunderstood element. Modern investors often view cash as an unproductive drag on returns, especially during bull markets when everything seems to be rising. But the Talmudic framework treats liquidity not as wasted opportunity, but as loaded potential. Cash reserves serve 3 critical functions that non-liquid assets cannot. First, they provide survival capital during disruptions, allowing you to weather downturns without forced asset sales. Second, they enable opportunistic deployment when prices dislocate. Third, they offer psychological freedom, the ability to make decisions based on wisdom rather than desperation. Every major investor from Warren Buffett to Ray Dalio maintains substantial cash reserves, specifically because optionality has enormous value that doesn't show up on standard return calculations. The interplay between these 3 categories creates something more powerful than their individual contributions. When real estate markets struggle, business ventures might thrive. When business conditions deteriorate, cash reserves become more valuable. When inflation erodes currency, land values typically rise. The system isn't designed to maximize returns in any single economic environment. It's designed to survive and gradually prosper across all economic environments, including those that destroy more concentrated portfolios. This is defensive architecture at the strategic level, ensuring that no single economic shock can devastate your entire financial position. History provides compelling evidence for this approach. Jewish communities dispersed across dozens of countries over 2,000 years faced every conceivable economic challenge. They experienced hyperinflation in Weimar Germany, confiscation under various regimes, multiple banking crises, and continuous political instability. Yet family wealth frequently survived across generations, often because the rule of thirds prevented total commitment to any single asset class that could be destroyed or seized. When European banking systems collapsed, those with land holdings remained solvent. When property was confiscated, those with business networks elsewhere could rebuild. When all else failed, liquid reserves provided the means to start over in new territories. Modern research supports what ancient wisdom established through experience. A 2009 study examining true Talmudic investing found that portfolios structured with thirds allocated to rate, stock indices, and treasury securities produced risk-adjusted returns that frequently matched or exceeded more sophisticated optimization strategies. The reason involves estimation error in complex portfolio models. Mean variance optimization, the mathematical foundation of modern portfolio theory, requires accurate predictions of future returns, volatilities, and correlations. When those estimates prove inaccurate, which happens regularly in real markets, optimized portfolios often underperform simpler allocation rules. The Talmudic strategy sidesteps this problem entirely by ignoring predictions and maintaining structural balance regardless of market conditions. Benjamin Graham, the father of value investing and Warren Buffett's mentor, developed his concept of margin of safety independently, yet it mirrors the Talmudic principle remarkably. Graham argued that the greatest danger in investing isn't ignorance but overconfidence, the certainty that leads to excessive concentration. He advocated for portfolio structures that could withstand being wrong without catastrophic consequences. The rule of thirds embodies this philosophy at the allocation level. You can be completely wrong about one asset class and still retain 2/3 of your capital. You can suffer a 50% loss in one category and experience only a 17% total portfolio decline. This built-in resilience transforms investing from gambling into patient wealth accumulation. The practical application begins with honest assessment. Most people discover they've unknowingly violated the balance, often severely. It's common to find individuals with 80% of their net worth tied up in their home and retirement accounts, less than 10% in accessible liquid reserves, and minimal exposure to productive business ventures outside their employment. This structure leaves them vulnerable to housing market downturns, illiquid during opportunities, and entirely dependent on employment income without ownership in growing enterprises. Correcting this imbalance doesn't happen overnight, but recognizing the goal allows for deliberate progress over time. Rebalancing toward the thirds doesn't mean selling your house or abandoning your career. It means gradually accumulating assets in underweight categories. If you're heavily weighted toward real estate, perhaps your next investment focus should be business equity through index funds or direct ownership opportunities. If you're predominantly in stocks through retirement accounts, building cash reserves and exploring real estate exposure becomes priority. If you're hoarding cash from fear, systematic deployment into the other categories reduces opportunity cost while maintaining the liquid third. The path to balance is personal, but the destination is universal. 1/3 in each major category, providing comprehensive economic participation with comprehensive protection. The liquid third deserves special attention because it contradicts contemporary financial culture. You'll be told that cash is trash, that inflation is eating your reserves, that you're missing gains by staying in money markets. All technically true during certain market phases, yet fundamentally missing the point. The liquid third isn't meant to generate returns. It's meant to generate options. When markets crash and everyone else needs to sell depressed assets to raise cash, your reserve allows you to buy. When your business competitor faces a liquidity crisis, your cash enables acquisition. When unexpected medical costs or family emergencies arise, your liquid reserve prevents liquidation of long-term holdings at inopportune moments. The value isn't in the return on cash, but in the return on opportunity that cash enables. There's also a psychological dimension that transcends pure mathematics. Maintaining significant liquidity creates mental spaciousness that improves decision-making across all life domains. Financial stress contracts thinking, forcing short-term survival mode that undermines long-term wealth building. Knowing you have substantial reserves creates confidence that manifests as patience, the ability to wait for genuine opportunities rather than grasping at marginal options. This psychological advantage compounds over decades into dramatically different outcomes, even if the direct return on cash reserves appears low in isolation. The framework adapts across different wealth levels. For someone just beginning, the thirds might mean 1/3 building a down payment for property, 1/3 investing in index funds or business development, 1/3 maintaining emergency reserves. For mid-career accumulators, it might mean 1/3 in home equity plus rental properties, 1/3 in diversified equity holdings and possibly ownership in the business they work for, 1/3 in accessible cash and short-term bonds. For substantial wealth, it might mean 1/3 in commercial real estate and land holdings, 1/3 in private equity and business ventures, 1/3 in treasury securities and other liquid instruments. The specific vehicles change with scale, but the structural principle remains constant. Critics might argue that this approach seems conservative, potentially sacrificing returns compared to more aggressive strategies. This criticism misunderstands the objective. The rule of thirds isn't designed to maximize returns during specific market periods. It's designed to maximize the probability of maintaining and gradually building wealth across all possible future scenarios, most of which we cannot predict. In any given decade, a more concentrated strategy might outperform. Over multiple generations facing unpredictable challenges, the balanced approach demonstrably survives where aggressive concentration often fails. The Jewish family's Hove maintained wealth across 20 generations weren't the ones who bet everything correctly once. They were the ones who structured their holdings so that being wrong couldn't destroy them. Perhaps most importantly, this framework transforms inheritance from mere wealth transfer to wisdom transfer. When children observe their parents maintaining this balance, they internalize principles more valuable than any specific asset. They learn that wealth isn't a number but a structure. They understand that true security comes not from maximizing any single asset, but from balancing different economic exposures. They see firsthand how liquidity creates opportunity while ownership creates growth. This education, passed through example across generations, explains how certain families maintain prosperity despite having no special access, no insider advantages, just structural discipline applied consistently across changing circumstances. The rule of thirds isn't religious doctrine requiring faith. It's practical architecture that happens to originate from religious teaching. You don't need to be Jewish to benefit from this framework any more than you need to be Italian to appreciate Renaissance art. The wisdom transcends its origin because it addresses universal economic realities. Uncertainty about the future, the tendency of different assets to perform differently under different conditions, the value of liquidity during disruption, and the psychological benefits of balance. These truths apply regardless of your background, and the structural solution works regardless of your beliefs. Implementing this framework requires patience and discipline more than sophistication. You don't need complex derivatives or exotic investments. You need clarity about your current allocation, honesty about where you've concentrated risk, and systematic steps toward balance over time. Track your net worth across the 3 categories quarterly. When one category grows disproportionately, direct new resources to underweight areas. Resist the temptation to chase performance by overweighting whatever performed best recently. Trust the structure even when, especially when, it feels suboptimal. The value reveals itself during transitions, crashes, and unexpected events, precisely when aggressive concentration proves catastrophic. The Jewish wealth ratio of 33-33-33 isn't magic. It's mathematical elegance applied to irreducible uncertainty. We cannot predict which assets will perform best over the next decade. We cannot foresee which economic shocks will materialize. We cannot know what opportunities will emerge. But we can structure our holdings so that we benefit from whatever transpires while surviving what we failed to anticipate. This is the essence of the Talmudic framework, and it's precisely why it has outlasted countless more sophisticated strategies that worked brilliantly until they didn't. In a world of infinite complexity and unpredictable change, sometimes the most powerful strategy is the one simple enough to maintain across generations, robust enough to survive everything, and wise enough to know that survival itself is the foundation of lasting prosperity.